Hey, thanks for joining us for another edition of Ace Your Exam with InsuranceTestHelp.com. Today we're doing a practice test for the life and health insurance exam. You don't have to take these two together, but most people do. So there's a little bit of both the life exam and the health exam. And then at the end, there's a few questions that are on the P&C exam as well. For those people that haven't already taken the P&C, obviously there's going to be a whole bunch of definitions that are going to be included on your life exam as well. If you've already taken the P&C, you're going to know a lot of those. If you haven't, be sure to do the last few questions as well. Here we go. When is the earliest a life policy may go into effect? A, when the insurance underwriter approves the application. B, when the application is signed and payment is given to the agent. C, when the agent submits the application to the insurance company. Or D, when the policy has been delivered. So the answer here is going to be B. The policy can be effective as early as the date of application if the premium is submitted with the application. This also requires that the policy is issued as applied for. Obviously, if there's some table rating or some things like that, the effective date may be different. Which of the following is not true regarding policy loans? Remember, this is an except question, so you're looking for the untrue statement. Policy loans can be repaid at death. Policy loans are taxable withdrawals. A policy loan may be repaid after the policy is surrendered. Or D, insurance companies often charge interest on policy loans. Which one of those is not correct? The not correct one is going to be B. Policy loans are taxable withdrawals. Policy loans are not taxable. Policy loans can be repaid at any time, including surrender and death. And an insurer can charge interest on outstanding policy loans. So the incorrect one is going to be the taxable withdrawal question. Keep in mind, a lot of the exams have these except and not questions just to kind of trip you up. So always read the question thoroughly and look at all the answers. I know that seems really obvious, but it probably will save you a couple of questions. Okay, next up we're going over to health question. All of the following are covered by Part A of Medicare, except A, post-hospital nursing care, B, home health care and services, C, physician and services, or D, inpatient hospital services. Remember, we got another except question here. This is going to be C, physician and service and surgeon services are not part of Part A, which was the question. They're actually covered under Part B. So just look for that sort of word trickery trying to get you on the exam. What is the primary purpose of the grace period in a life insurance policy? A, to protect the insurer from fraud. B, to allow the policyholder time to pay a missed premium without losing coverage. C, to prevent the policy from being canceled due to non-payment. Or D, to provide additional coverage at no cost. So the answer is B, to allow the policyholder time to pay a missed payment without losing coverage. So the grace period gives the policyholder extra time to pay the premium before the policy lapses. What distinguishes a fixed annuity from a variable annuity? A, the fixed annuity guarantees a specific payout, while the variable annuity payout depends on the performance of investments. B, a fixed annuity provides a lifetime income, while a variable annuity does not. C, a fixed annuity has no accumulation period, while a variable annuity does. Or D, a fixed annuity can only be purchased by retirees, where a variable annuity is for pre-retirees. So the correct answer here is going to be A. The fixed annuity guarantees a specific payout, while the variable annuity payout depends on the performance of investments. A fixed annuity provides you a guaranteed predetermined payout, while the payout on your variable annuity fluctuates based on the performance of the underlying investment options. So I really think there's an awful lot of too many questions on variables on the life exam, considering that you can't sell any of them without a securities license as well. But just keep in mind, if you do have reading material, to take an extra read through all of the questions on variable annuities, because there is quite a few questions on that. What is the purpose of the incontestability clause in life insurance policies? A, to allow the insured to contest the policy terms. B, to prevent the insurer from contesting claims after a certain period. C, to guarantee premiums remain the same. Or D, to ensure the death benefit is paid regardless of circumstances. So this is one where read the entire question, because there's a couple of these you could probably rule out without even knowing the right answer. So the correct answer is going to be B, to prevent the insurer from contesting claims after a certain period. After a policy has been in force for a set period, the insurer cannot contest the policy's validity, even for misstatements. Which of the following best describes the concept of insurable interest in life insurance? A, a person being insured must be related to the policyholder. B, the policyholder must benefit financially from the insured's continued life. C, the policyholder must have permission from the insured. Or D, the insured must have a high income to qualify. Remember that you must have an insurable interest at the time of claim in life insurance. So the correct answer is B. The policyholder must benefit financially from the insured's continued life. So if, for example, you have a life insurance policy on yourself and the beneficiary is your spouse, obviously you have an interest in yourself being alive, but your spouse can also take out a life insurance policy on you because she has a financial interest in you remaining alive. It's better financially for her if you're around than not. So that is insurable interest in life insurance. What is the main difference between a participating and a non-participating life insurance policy? A, the face value of the policy. B, the cash surrender value. C, the payment of dividends. Or D, the premium amount. It's going to be C, the payment of dividends. A participating policy pays dividends to policyholders, while a non-participating policy does not. A policy will pay the death benefit if the insured dies during the 20-year premium paying period, and nothing if death occurs after the 20-year period. What type of policy is this? A, whole life. B, ordinary life policy. C, limited pay whole life. Or D, level term. The answer is going to be D. 20-year term policy is written to provide a level death benefit for the 20 years and no longer. So just remember, with the term policies, they end. So if it's a 10-year term, it's after 10 years. Kind of like renting a house for 10 years. You only get to live there for the 10 years you leased it for, and after that you're out. Whereas a whole life policy lasts your entire life. You own it. You're not renting it. Which of the following care types is generally covered by long-term care insurance? So back to the health side. A, acute hospital care. B, hospice care. C, skilled nursing facility care. Or D, routine doctor visits. So the answer here is going to be C, skilled nursing facility care. Long-term care insurance typically covers this: skilled nursing facility care, home health care, assisted living. So just keep in mind, if you're not familiar with the long-term care, there are going to be some questions on your exam about it. So reread whatever material you're studying from on the long-term care section. Which of the following requires a security license as well as an insurance license? A, level term. B, variable life. C, universal life. Or D, a deferred annuity. So the answer is going to be B, the variable life, Variable policies require you to have a life insurance license as well as a security license to sell it because it has the investment product. So there is a lot on variables. I don't know why when you can't sell them till you get your securities license, but just go ahead and make sure that you are really familiar with variables because there will be several questions on your exam. I'll almost guarantee it. Jane studies in Hong Kong for a year. While there, she's involved in an accident that leaves her disabled. If she owns a general disability policy, what will be the extent of the benefits that she receives? A, full benefits, B, 50%, C, 25%, or D, none? The correct answer is D, none. Tricky question. General disability policies have exclusions. So they have things they do not cover, such as losses from war and military service, intentional self-inflicted injuries, overseas residence, like if you live in Hong Kong for a year, or injuries where you suffered them while you were committing or attempting to commit a felony. What type of hospital policy pays a fixed amount each day that the insured is in hospital? A, surgical, B, blanket, C, Medigap, or D, indemnity? So the correct answer here is going to be D. A hospital indemnity policy pays a fixed amount each day the insured is hospitalized, and it's unrelated to your medical expenses. When I first took the life and health exam, I was like, who would ever need one of these? And it has turned into one of my absolute favorite policies. We all know the advertisement from a certain insurance company on TV where they pay your bills. It has a little critter in it. It's unrelated to your medical expenses. So it's to pay for things like your bills. So if you had something like $50,000 in medical bills, it wouldn't matter. They'd still pay the same amount a day, $250 a day, $100 a day, whatever the amount is. But even if you were only in the hospital for like 2 days, they would pay the flat fee that normally has going in. So that is a hospital indemnity policy. It pays you usually just a cash check to you, not anything to do with reimbursing your medical expenses to the hospital. So keep that in mind because they do tend to like the hospital indemnity policy on the exam. COBRA applies to employers with at least how many employees? 50, 20, 80, or 60? If this one isn't on your exam, I'd be amazed. 20 employees. Under COBRA, the Consolidated Omnibus Budget Reconciliation Act, which you do not probably need to know, employer with 20 or more employees must extend group health coverage to terminated employees and their families. So that is COBRA. The death protection component of universal life insurance is always A, whole life, B, adjustable life, C, decreasing term, or D, annually renewable term. Correct answer is D, annually renewable term. Remember, universal policies have two components, the insurance component and a cash account. The insurance component, the death benefit of a universal life policy is always, this is the death protection, is always annually renewable term. So as you get older, that annually renewable term gets more and more expensive and tends to eat away at your universal life benefit. The child term rider attached to a life insurance policy provides A, coverage for the policyholder's spouse, B, additional benefits in case of accidental death, C, temporary life insurance coverage for the policyholder's children, D, a waiver of premium if the child becomes disabled. So remember, this is another one where it's good to read all of the questions because a couple of them might be ridiculous. C, temporary life insurance coverage for the policyholder's children is the correct answer. A child term rider offers term life insurance coverage for policyholders' children, usually until they reach a specific age, such as 18 or 25. What is the primary function of a waiver premium rider in a life insurance policy? A, it pays a lump sum if the insured becomes disabled. B, it allows the policyholder to take loans from the policy. D, it waives premium payments if the insured becomes totally disabled. Or D, it increases the death benefit upon disability. So the correct answer is it waives premium payments if the insured becomes totally disabled. The waiver premium rider ensures that the policy will remain in force if you became disabled. This is going to be another question. I will guarantee you there will be something about credits and Social Security on your exam. So be sure that you have studied a bit about the credits. It's not just going to be the maximum fully insured credits. There's going to be probably something about someone's age. So make sure you review everything about credits and Social Security. Which of the following is required for an individual to be considered fully insured under Social Security? A, at least 40 credits of coverage. B, at least 10 credits of coverage. C, at least 20 credits of coverage, or a minimum age of 65. Correct answer here is going to be A. At least 40 credits of coverage are required to be fully insured for Social Security benefits. You have your whole life to earn them. 40 credits is a quarter's worth of coverage. So if you work 1 year, that's 4 credits, like each quarter of work gets 1 credit. So 40 credits is equivalent to 10 years of full-time work. Which is the following types of annuities guarantees payment for a specific number of years, regardless of whether the annuitant lives or dies? A, immediate annuity. B, fixed annuity. C, life annuity with periods certain. Or D, a variable annuity. Correct answer here is going to be C, life annuity with periods certain. Life annuity with periods certain guarantees the payment for the lifetime of the annuitant or a specific number of years, whichever is longer. So if you had a life annuity period certain for 20 years, if you died in 1 year, you would still get it for 20 years. Well, your beneficiaries would, because you wouldn't be alive anymore. In a disability income insurance policy, the elimination period refers to A, the time between a claim and when benefits begin. B, the period when the insurer can cancel the insurance policy. C, the time it takes to process a claim, or the waiting period for coverage of pre-existing conditions. So your correct answer here is going to be A, the time between a claim and when benefits begin. Your elimination period is the waiting period after you become disabled, but before the disability incomes are paid. So it serves as a type of deductible, and the longer the elimination period, usually the cheaper the disability insurance. Which of the following would help prevent a universal life policy from lapsing? A, minimum payments. B, waiver of insurability. C, target amount. Or D, stop loss amount. So it's C, target amount, universal life. People should be paying the target amount. They tend to lean towards paying the minimum amount. And later when they get older, they have to pay way more. So target amount is what prevents your universal life from lapsing, because that is what the illustration is based on, you actually paying. Under workers' compensation, disability income benefits typically replace what percentage of a worker's lost wages? A, 25%, B, 50%, C, 66.2%, or D, 100%. The correct answer here is going to be C, 66 2/3%. Disability income benefits under workers' compensation generally provide about 66 2/3%. So it's 2/3 of your income and of your average weekly wage, depending on what state you live in. What type of premium do both universal life and variable universal life policies have? A, increasing, B, flexible, C, level fixed, or D, decreasing. So the correct answer is B, flexible. Variable universal life, like universal life itself, has a flexible premium that can be increased or decreased as you choose or as your life happenings require. So as long as there is enough money in the policy to fund the death benefit. So it will, so you can make it, there's a minimum, there's a target, which is what you're supposed to pay. So it is flexible up and down. What characteristic makes whole life permanent protection? A, living benefits, B, coverage until death or age 100, C, guaranteed death benefit, or D, guaranteed level premium. So the answer here is going to be coverage until death or age 100. Whole life policies are referred to as permanent protection because as long as you pay your premiums, your coverage will continue for the rest of your life, your whole life. What is the purpose of the probationary period in a health insurance policy? A, to allow coverage for pre-existing conditions immediately, to establish a waiting period before certain coverages begin, C, to reduce the premium amount, or D, to eliminate coverage for accidental injuries. The correct answer is going to be B, to establish a waiting period before certain coverages begin. The probation period is a specific time frame that must pass after the policy is issued for certain conditions, usually illness. So you can't go run out and buy a policy because you're sick or have COVID and get coverage. So that is to allow a certain waiting period for illness to be covered. Accident is covered from day one. Which rider allows the policyholder to purchase additional insurance coverage at specified intervals without proving insurability? A, waiver premium rider, B, accidental death benefit rider, C, guaranteed insurability rider, or D, accelerated benefit rider. This is going to be C, your guaranteed insurability rider. That allows you to buy additional coverage without undergoing medical exams, typically at certain ages or life events. So if you were to buy a whole life policy, there would be options such as when they turned 18, when they turned 21, when they got married, when they had a baby, all throughout their life where they would be eligible to purchase additional insurance without having to prove that they were insurable. Okay, we are moving on to a few definitions that are on the life and health exam, but these are also ones that are on the P&C exam. So if you recently took your P&C exam, you're going to know them. If it's been a while, you might want to check on them for review. There's only a couple in here, and there's a whole lot more that apply to both exams. We have some videos specifically on all the definitions that are on both exams, but these few are some of the ones that I will guarantee are on both the life and health exam and the P&C exam. So if you're taking the life and health exam first, or it's the only one you're going to take, you really want to pay attention to these ones, okay? Okay, the part of a policy that shows the amount of insurance, premium, and policy term is the A, conditions, B, declarations, C, exclusions, or D, endorsements. Correct answer is going to be B, declarations. It's where we're going to find all those good things. Be sure that you know all of the parts of the policy because they are for sure going to be on your exam. Okay, next up, I'll guarantee this one's going to be there. Which of the following best describes the aleatory nature of an insurance contract? A, both parties are bound by all the clauses of the contract. B, anything unclear is interpreted in favor of the insured. C, only one party is bound by the contract, or D, there is an exchange of unequal values. So the correct answer is D, there is an exchange of unequal values. Aleatory is one of the favorite words, it seems, of all insurance exams, so be sure you really understand that one. An aleatory contract is one where you pay a very small amount, your $100 a month premium per se, for your car, and it protects you in the event that you have a catastrophic accident, you kill someone, and you have to pay out hundreds of thousands of dollars. The insurance company pay that in exchange for your really small amount that you paid. You get this huge level of protection. That's the automobile side of it. On the life insurance and health insurance side of it, you pay a very small premium for your health insurance in exchange for possibly being in the hospital and having a surgery that could be $50, $100, $500,000, and you're only paying your $300 or $400 a month for your health insurance. So just keep in mind, small amounts you're paying, a large amount you're protected for, in exchange of unequal values. What contract characteristic describes a contract that is drawn up without negotiation and the insured has little or no input in the provisions? A, unilateral, B, conditional, C, provisional, or D, adhesion. A contract of adhesion describes one where it is prepared by the insurance company and the insured only has the option of accepting or denying. Take it or leave it. There is no negotiation on the policy provisions, so keep in mind that is a contract of adhesion. We covered this a little bit in a question earlier, but what does an insurable interest mean in an insurance policy? A, the insurer's financial stake in the policyholder's risk. B, the legal right to insure something because you would suffer financial loss if damaged. C, the policyholder's ability to increase their coverage at any time. Or D, a third party's interest in whatever is covered in the insurance policy. So this is going to be B, the legal right to insure something because the insured would suffer financial loss if damaged. So on the life insurance side, this is going to be your right to insure your life or someone that is close to you's life who, if they died, you would suffer financial loss. So for example, a wife has the right to insure her husband because if he died, she would suffer a financial loss. It is also the reason you cannot insure strangers because you have no skin in the game. There is no financial loss for a stranger if they insure somebody and they die. So that is insurable interest, and it will for sure be on your exam. So make sure you understand it. Okay, we've come to the end. How did you do? We're wishing you the best of luck on your exam. We hope this really helped you. Would love to hear what kinds of these you prefer. Do you prefer the questions with the answers like these sort of mock exams, or do you prefer the ones where we sort of go through the definitions? Would love to get some feedback. If you are enjoying our channel, we would love for you to subscribe and like and share, and we hope that this truly helped you pass your exams, and best of luck in your insurance career.